2014, market's done sensationally. Everyone's saying it's going to cool off. What do you say?
Well, I like that there's a lot of skepticism out there today. I mean, I think that's healthy. You know, we see it in the media headlines, you know, bubble stories. You know, we see it even in investor sentiment. You know, we follow American Association of Individual Investors sentiment survey. Believe it or not, the latest survey actually has less bulls than average in this 26-year-old survey. And there's still a lot of people who are underinvested, a lot of people waiting for the next shoe to drop, right? And of course, there's usually good reason for them to wait for, you know, that shoe to drop, because there's always something on the horizon, right? We still have the government having kicked the can, you know, down the road, and you know, we seem to have forgotten that there's going to be another big debate in Washington in a couple of months to see if we shut the government down again. So there's still a lot of things for people to worry about, which is a good thing. The market will climb, historically anyways, that wall of worry. Now, having said all of that, you know, to be sitting here up, you know, 30% or so in our newsletter portfolios and mutual funds, we have to, you know, keep things in perspective. You're not going to grow at that kind of level next year, in my opinion. Now, we could have the concept of a melt up as, you know, more and more investors come out of bonds. You know, this is part of the reason equities have done so well this year, is that the money that had gone to the safety of bonds has all of a sudden opened their statements and found that you have red ink. You know, Q2 was a horrendous quarter for bonds. And where did a lot of that money go when it came out of bond funds? It went into stocks. And so you could have a continuation of that, especially as the Fed ultimately starts to taper and interest rates move higher. So I think I'm positive for 2014. Where do I think we'll end the year? You know, I'd be expecting returns in line with the historical average, which has been, you know, 10 to 12%. And 10 to 12% in an environment where interest rates are microscopic, you know, would be a fantastic, you know, return.
Talking about microscopic interest rates, how does the Fed get out of the hole they've dug?
Well, that's the how many trillions? It's a $4 trillion question. They do it slowly, and they do it gradually. And, you know, the first step, of course, is to stop buying $85 billion a month, and to try to do that without impacting, you know, the credit markets, of course, and ultimately the financial markets in general. And so they do it delicately. And they do what they say they've been doing, which is we are data dependent. So it's an if-then statement. You know, if we start to see economic growth and some of the things that they've talked about as far as unemployment, obviously GDP growth, then they can start to unwind some of that, in my opinion, without causing great harm to the market. But having said all that, yeah, they're in this hole, right? And frankly, Uncle Sam is in the same hole, because we got to keep rolling over the $17 trillion or whatever it is in terms of the deficit. And, you know, there's a big difference between a, you know, 2% interest rate and a 3% interest rate when you're talking about, as they say in Washington, real money.